All right, welcome to Chapter 7. Well, we'll talk about long-term liabilities and specifically about, let's see, pull this up, about bonds issued at par, premium, or discount, and two different ways to account for the interest expense portion of those bonds or notes that you've issued. We'll go through the chapter materials as presented in the slides, but then what I think we'll find helpful is some examples. So I'll make sure to get some of those posted as well. But there are some examples in the slide deck, which we'll walk through. So long-term liabilities, just as a recap, is any liability that is not due within a year of a normal course of the operations of business. So long-term liabilities are those items over a year. Another name that you might have heard in past courses is non-current liabilities. A couple of examples would be, bonds or notes payables. So typically they're issued for multiple years. So they show up in the long-term liability sections, which follows the current liabilities on the balance sheet. When we're looking at those long-term liabilities, there's a concept that you may have heard before about being present valued. So we want to take into effect the fact that those dollars, those liabilities may be worth something different in the future than what they are today, because over time, there's an interest rate component, inflation related components, et cetera, that you need to account for over the time from the date it's issued to the time that it's actually paid back to your debtors. Okay, so the idea in this example here is the present value today might be $1,000, but say the interest rate that is being earned on that item is 10%. The future value a year from now is $1,100. Today it's only worth $1,000, but in the future it could be worth $1,100. So just to depict what we mean by present value. So a bond, just a reminder that it's a promise by us, if we're the issuer, that we will pay the investor at a specific date, a specific amount. So we could be known as the bond issuer if we're the one that's issuing the bond as being the company, or we as an individual, or maybe a bank, if we're operating on behalf of a bank, we could be the bond holder. And the agreement between the two organizations is what we call a bond indenture. So just a sample of what a bond certificate might look like. Not so much issued today, perhaps, but I remember growing up that I would buy, Canada savings bonds, and they look very much like this. So it would talk about, who issued them, what's the certificate, what's the face value, which is the amount that you get on maturity, and then what's your interest rate on an annual basis. Okay. So now when we issue bonds, there could be a few different scenarios. One is it could be at par, and that's where the current interest rate is equal to the market rate. Okay, so that's what we call at par. A premium is where a bond is likely to have an interest rate on it that's higher than market rate. So it's worth more, versus at a discount is where a bond is trading below its par value because the interest rate's lower than market rate. So say there's a bond that it promises a 3% annual interest rate, but the current market interest rate is 5%. Well, that would be considered to be sold at a discount because you're not going to pay them as much over time. So they get an upfront discount based on that differential. Okay. So just an example, if we issue them at par, this one's the easiest part is in this example, what if on December 31st, 2020, we issued a 1,000 10-year bonds at par, $100 each, with a 5% interest rate, annual interest, and it's where the market rate equals the interest rate on the bonds. This example is very straightforward. There's no discount, no premium. We would expect to receive cash from our buyers of that bond of $100,000, and we would have a liability, a long-term liability for $100,000. No premium, no discount. So then what happens when we make interest payments over time? The idea is we would pay an annual interest based on what was agreed upon. Most bonds call for semi-annual interest where you would pay twice a year. But in this case, an annual interest payment would be $5,000. So we would have to pay cash each year of $5,000. So say we issued it January 1st, every December 31st, we're paying the interest off. We would reduce our cash credit for $5,000 and debit our interest expense for the same $5,000. Should just double checking. Yes, you can hear me. All right. So What if it's, a part way through the year? So what if our year end is October 31st and we issued the bonds on January 1st? So just like we've done prorated for other calculations and other instances, you would do the same, where you would take 10/12 of that annualized interest. So you take the $100,000 par value times the 5% annual interest rate times the 10 months that you need to accrue for at year end, and record that amount of $4,167 as the interest expense on October 31st, and the interest payable would be the same, being a credit to that short-term liability for the interest portion. So then when you pay it on December 31st, assuming that's 2 months into the next fiscal, you would have to give up $5,000 in cash. Makes sense, for the full 5% on 100,000. You would reduce your payable, your interest payable, by the amount that was accrued at year end of $4,167, and then the difference would represent the interest for the 2 months of the new year. Again, there are some workbook examples that if you'd like to pause and take a look at them, or we will do some of those in another recording. All right, so now we're going to talk about premiums and discounts, where market rate and the interest rate being paid on the bond are different. And there are two different methods on how to amortize that difference, that discount or premium. There's what we call straight line, where it's the same amount every year, just like we talk about straight line depreciation. There's straight line amortization of premiums and discounts. And then after that, we will talk about the effective interest rate amortization method. So there are two different methods on how to calculate the annual amortization of the discount or premium. So let's first of all look at premiums and the straight line method. And so we need to know, how do we calculate the premium? So let's look at an example where we issue bonds for $100,000. They have an annual contracted interest rate of 10% in 5 years. And the interest on the bonds is payable semi-annually on July 1st and January 1st each year. So that's 6 to 12 months from the time we start. The company's year end is September 30th, and the market rate is 8%. Okay, so we need to know, in this case, how do we calculate the premium? So this is where you might recall your present value tables, or you might have a present value calculator, or you can use the function in Excel. So for this example, we have a future value of $100,000. We're told we're issuing $100,000. Because we're making semi-annual payments, we need to take the 10% annual interest and divide by 2. Okay, so we'll get 5% every 6 months. So 5% times 100,000 means we're going to pay $5,000 every 6 months. And that's stated based on our semi-annual interest rate. And the number of periods would be 5 years times 2 payments per year is 10 periods. So the present value of the $100,000 using the PV tables or your calculator would be $67,560. Then we need to look at, okay, what are the future interest payments that bondholder would receive? And we would pay them $5,000 every 6 months. So we look at the same discount rate. It's, in this case, it's 4% of 10 payments. So looking at the table, we would take the 5,000 times the 8.1109 equals 40,555. Adding the two together, the total cash flow in present value terms would be $108,115. So that tells us that if you take the $108,000 and change less the $100,000 face value for the bond, there is a premium paid for this bond of $8,115, because the present value of the future cash flows exceed the present value of the bond, or sorry, the face value of the bond. So just to give you a little picture of it, this shows the fact that you're paying $5,000 every 6 months. Okay, the market rate's only 4%, which is why there is a premium. And again, here's a sample of the present value tables. Okay, so that's where we pulled the 0.67556. And the present value of future payments, so an annual recurring payment, or sorry, semi-annual in this case, so 10 payments at a 4% average every 6 months, gives us 8.11 as our multiplier. Okay, so those are included in the PowerPoint deck that you have access to. Again, you can also use a calculator or Excel. In this case, just to recap, the price that they're willing to pay based on those cash flows is higher than market because they're going to earn more interest on that bond than they could elsewhere. So when we issue the bond, the idea is those purchasers will pay us more than the $100,000. So we would set up a long-term liability of bonds payable $100,000 because that's all we will pay back in 5 years. We will receive cash from our investors, the people buying those bonds, for $108,115, so debit cash. And then the difference is our premium. So it's a credit to the premium on bonds payable of $8,115. So then if we set up a little table, assuming that our year end is December 31st each year, so these are annual tables. So our 10 payments periods, okay, is down the left-hand side. What are our interest payments? Being $5,000 every 6 months. And then under the straight line method, we would just take the premium on the bonds and amortize them equally over the 10 periods. And we just rounded for demonstration purposes. So the last one is only 807 instead of 812. Our interest expense would be the difference between the interest payment of $5,000 and the premium. So the expense sitting in your books is only $41.88. We have a declining balance of our premium, okay, on our balance sheet, and then our bond book value slowly decreases down to end at $100,000 at maturity. Okay, so I think if, as you're working through exercises, setting up a table like this hopefully helps you walk through what the value should be out of those points in times. Let's record the first interest payment. So on July 1st, 2020, the first payment date, we make a $5,000 interest payment and we record that as a credit to cash. The rest of the journal entry then is an $812 debit to the premium on bonds payable. So we're reducing the premium because 6 months has passed. Every 6 months, that premium will be worth less. And then the debit to the interest expense would be the difference, as we talked about in the previous table, of $4,188. All right, so yeah, this recaps what we just said. Amortization of the premium is adjustment calculated as the difference between the cash and the interest expense. Okay, when financial statements are prepared, the premium on the bonds is added to the face value of the bonds. So in financial statement presentation, you don't just show the $100,000 bonds, you show the $100,000 plus any premium or subtract any discount, and that's the true face value or book value of those bonds. It's just like when you present the net book value of equipment or your assets, you're showing the net book value or face value, the current value per your books, including any premium or discount. Okay, so since the year, okay, another example here is what if the year end was September 30th? Then Energy Bite, the company needs to accrue interest expense before the second payment on January 1st. And so at each year end for the next 5 years, there's also a prorated portion of the interest expense. Okay, so if say on September 30th, it's our year end, it's 3 months out of the 6 months in, so we need to record half of that interest payment being $2,500. Therefore, we need to record half the premium as well for that period. So just like how you would prorate amortization on equipment for smaller periods, you would do the exact same thing for premiums or discounts. And then on January 1st, when you make the payment, then the full cash is given up as a credit of $5,000. Our interest payable would then be paid off of $2,500. Our premium on bonds payable will reduce by another 3 months worth in $406, and the difference would be our interest expense for those 3 months past for October, November, and December. Just trying to think, what are we trying to say here again? Just a reminder that as per the amortization schedule, as the premiums amortize over the payment cycle of that bond, by the time that we get to maturity, the bond is only worth what the face value was. So we'll move on to discount. Same process, just opposite math. So what if we have this example where we issue bonds worth $100,000, the market interest rate is 12%, but we're only paying 10% over 5 years, and we're paying semi-annually again. So same kind of process, the only difference is the market rate's higher, therefore there'll be a discount. So you go through the same kind of calculations. What's the present value of the principal based on 6% every 6 months, so that's 10 periods to equal 5 years. Present value of the future interest payments, 6%, 10 periods, 5,000 every 6 months. So the present value would be 92,640, which would be what they'd be willing to pay because they're earning less interest on this bond than they could elsewhere. Subtracting the 92,640 from the face value of the bonds of 100,000 gives us a discount calculation of $7,360. So again, we've got this little chart here just to show that for 5 years, every July and January, you'll pay them 5,000. Okay. Again, our present value tables, that's 6% 10 and 6% 10 for annuities. Okay, in this case, because it's a discount, we use what's called a Contra account. So it's the opposite way. So we've used Contra in many cases in other areas on our balance sheet. But in this case, the Contra account would be called discount on bonds payable. So our bonds, instead of being a liability of $100,000, would always be slightly less than $100,000, but slowly grow to $100,000 by the date of maturity. So in this case, and there's some rounding differences in this default, unfortunately, I couldn't change it or forgot to change it before we started. I'm not worried about a $1 rounding, okay? So in this situation, we issued the liability that we will owe those bondholders, the $100,000 credit, but they're only gonna give us $92,640, say, in cash, and $73.60 would be the discount on bonds payable debit. The net book value of our bonds on issuance then would only be the $92,640. So setting up a similar table was showing the straight line amortization of the discount. We have an interest payment of $5,000 every 6 months, but then we amortize the discount straight line over 10 periods for $736 a period. So our effective interest rate then is actually $5,736. And then our discount balance would decline every period, showing an end result of $100,000 for a bond value in 5 years or 10 periods. Okay, so our first interest payment then, 6 months in, July 1st, we would record the reduction of cash credit of $5,000, reduce the discount, $736, and then the debit to our interest expense for the effective amount of $5,736. Okay, and the idea again is over the 5 years, our book value or net book value for those assets would be $100,000. Okay, so what if it was a partial year? So just like everything else, we would accrue for 3 months. So if it's $5,000 for 6 months and our year end was September 30th, our last payment was July 31st, or sorry, June 30th, or July 1st, the same date. Then 3 months later, at our year end, we need to accrue half, so it'll be the $2,500 in interest payable out of the $5,000 calculated owing. $368 would be half the discount on bonds for those 3 months, and then our interest expense accordingly. And then moving forward, if on January 1st we made the payment of $5,000, we would reduce or credit our cash $5,000, reduce our account interest payable, debit $2,500, and then the balance of the transaction would be amortization of 3 more months of discount on the bonds payable of $368, and then a debit to the interest expense for those 3 months, which would be the $28.68 as per our table of calculations. Okay, again, and no matter what, whether it's discount or premium, at the end of the 5 years, when we repay the cash to the bondholder, the book value of our liability is $100,000 in both cases. So the payment, January 1st, 5 years after the date of issuance, would be the same no matter what they pay, whether it was a discount or a premium. So it would be a credit to cash of $100,000 and a debit to bonds payable of $100,000. All right, so now we're going to flip over to effective interest rate. So we're going to jump back into our value. Okay. So what if the market rate was 8%, $100,000 face value, 10% coupon bond, priced at a premium because the interest on our bond is better than the market. So same kind of process, same calculations. The only difference is how we amortize the premiums in these cases. So our initial issuance of those bonds would be the same as our previous example. $100,000 liability for bonds payable, credit of $100,000 using our present value calculations that we just popped up on the screen, same as the first example. We're showing a premium on the bonds of $8,115, and the total cash they're willing to give us would be $108,115. Okay. Now, under effective interest rate method, there are different calculations we need to do when we record the transactions for the interest payment. So when we look at the bond, we have a coupon rate and a market rate, and we have a face value of the bond, and we have a net book value of the bond. Okay, so the interest actual payment that we make is always based on the coupon rate, which is 10% per year or 5% for every 6 months, times the face value of the bond. So the technical interest payment would be $5,000. But our interest expense is calculated looking at the market rate times the net book value. So if our market rate is only 8% per annum, which is 4% for 6 months, times the net book value, which currently is $108,115 because we haven't amortized the premium yet. This is our first payment cycle. Will give us an interest expense of $4,325. So therefore, the payment less the expense, the payment of $5,000 plus the expense of $4,325 would equal the amortization of the premium. So looking at our journal entry, and we'll show a table shortly, we would actually make the cash payment of $5,000 as normal, but our interest expenses as per this calculation of $4,325 debit interest expense based on the market rate times net book value of the bonds, and then the difference is our premium on bond amortization. Okay, $675. So presenting this as a table, doing the calculations every 6 months. Okay, we showed the interest payment of $5,000 per cycle. Our interest expense is calculated, and it declines over time because the net book value of our bond is slowly reducing as the premium is amortized. Therefore, our interest expense decreases and our premium amortization increases in a premium situation. And again, our bond is worth $100,000 at the end. Partial periods, exact same. You would just take the prorated amounts for, how many months? Is it 3 months? Is it 4 months? Whatever that might be in this example. You would still do the same calculations, interest expense versus interest payable for those 3 months. So in this example, we would have our interest payable of $2,500, interest expense of $2,149. Okay, and our premium bonds of $351. Here we go. This is the journal. All right, so discount is same numbers as we did in straight line, but for effective interest rate. Just to recap, we have a market rate of 12%, coupon rate of 10% with $100,000 face value. So in this case, they're only willing to pay $92,640. So exact same opening entry. Don't worry about the $1 rounding. So then when we make our interest payment under an effective interest rate method of amortization, it's the same function. You calculate the interest payment, coupon rate times face is $5,000. And what's the interest expense, which is the market rate, which is currently 12% per year or 6% for 6 months, times the net book value, which is $92,640. It's $5,558. So our amortization of the discount is the difference. So our journal entry, as you can see on screen, is a credit to cash for $5,000 that we're actually physically giving the bondholder. An interest expense recorded per our calculations of $5,558, and then the discount on bonds is credited for the differential. So again, popping this up on a table, it looks the same. The only difference in this case is when you issued at a discount, your interest expense slowly increases instead of decreases over the life of those payments. And the discount amortization slowly increases as well. Okay. So then our bond amortization cost, again, after 10 payments or 5 years is worth $100,000 owing. Partial periods, exact same calculation. If you had 3 months out of the 6, instead of the 6 full months, you would do the same calculations. We have the example on screen. I won't walk you through that. Hopefully, once you do it one way, it's the exact same the other way. And again, we'll do some exercises from the workbook. Not in this recording, but in a separate one. All right, and this is when the payment is made. So when we make the $5,000 payment and we're only 3 months into the new fiscal year, our interest payable would reduce by the $2,500. We would do the same calculation for 3 months, be in the first 3 months of the year, to give us our calculation for interest expense, and then the discount falls out. Okay, now when the bonds are retired, it's known as redeeming the bond. So a bondholder very often redeems the bond, and they're able to pay them back. Oh, sorry. What we're trying to say there is if we redeem them before the date of maturity, because we issued a redeemable bond, we have that option. We have to clear out any remaining premium or discount. So obviously, if we get rid of the liability, we have to get rid of the premium or discount associated with the bond. So I think we have an example in here. Yes, we do. So if we wait the full 5 years and it's worth $100,000 on our books and we pay the $100,000 back, it's as simple as credit to cash and debit to the liability bonds payable for the $100,000. What if we exercise a call or a redeem option at the end of year 4? So if we look at our table, at the end of year 4, which is payment 8, we would have a discount balance in this case, in this example, of $1,472 remaining. So the book value would be $98,528. However, we might pay something different than $98,528. So what if we paid $99,000? Okay. So if we paid $99,000 to buy those bonds back, we would give up cash of $99,000 credit. We need to get rid of the bonds payable, $100,000. We need to get rid of what's remaining on the discount of $1,472. And the difference would be the loss, because we paid more than what the net book value was of those bonds. So we would have a loss on bond redemption in this example of $472, and that does happen. Okay. So bonds payable on the financial statements, how it's presented is if the bonds are issued at par, the balance sheet reports the long-term liability equal to the face value. So it's $100,000 forever. If it's at a discount, it's always based on the bond's carrying value, or at a premium, it's always at the bond's carrying value. So if it's issued at a premium, the value would be higher, slowly decreasing. If it's at a discount, it's lower and slowly increasing over time. So for example, we had our $100,000 bond issued. It was issued at a discount of $92,640. Okay. So our presentation here, bonds payable. This is going 9 months forward. Okay, so this is September 30th, so 9 months after the first issuance. So it's worth, our net book is $93,744, and we show the discount. Okay. If it's at a premium, you'll see the disclosure, bonds payable 10% when it's due. What's the premium? So our total long-term liability, or bonds payable in this case, would be $106,897. This is as of September 30th. Okay, so it's 9 months in. Okay. Okay, last couple of things we'll cover are some other ratios that come into play. You may or may not have seen these ratios before. But one helpful item that debtors and creditors might look at is our debt to total assets ratio, which looks at our total liabilities divided by total assets. So in an example, what if a corporation has 10 million in total assets, 4 in total liabilities, and 6 in equity? Our debt to total assets ratio would be 0.4, 4 million divided by the 10 million. So that means 40% of the company's assets are financed by debt. So it's either debt to a shareholder, or sorry, not to a shareholder, debt to a bank, debt to a bondholder, versus 60% are funded by its shareholders, stockholders, retained earnings, whatever that might be. Okay. It depends on the sector and what kind of business you're in, on what kind of ratio would be acceptable. But again, this is so you can compare it to others. You know, how leveraged are they on debt versus leveraged on owners of the business? Okay. So another ratio is a debt to equity ratio, where we look at total liabilities divided by total stockholders' equity. So again, in the same example where we had 10, 4, and 6, we would look at their total liabilities of 4 divided by our equity of 6 is 0.67. So what that means is they have 67 cents of debt for every dollar in equity. And you would typically want a 1-to-2 or a 0.5 ratio would be kind of the ratio. So it's close, but I would say they're not as leveraged as they should be, they're over leveraged in debt, not as leveraged against their shareholders. Hopefully you found that helpful, and take care.